Okay, this is a little bit different video than some of the previous ones I posted where I've just gone over GDP and the crude oil market and the treasury market and where I think Fed policy is going to be in 2019. This is more of a trading video that deals with mean reversion and using a synthetic future strategy. There's a couple of different ways that you could use synthetic future strategy. The way that I look at it is it's a long ball strategy that's focused on mean reversion, and ultimately the goals of the strategy are you're attempting to extract the difference between realized volatility and implied volatility. The mean reverting aspect of it is basically on one standard deviation to the left of the distribution curve, and also one standard deviation to the right side of the distribution curve. Typically, you can expect portfolio realized volatility or historic volatility of the portfolio is going to be between 16 to 20%. That's a very high volatility for a portfolio. But to lower the overall portfolio volatility, you can sell variance back into the market, which is a short vol strategy that tends to reduce elevated levels of volatility within a portfolio. And one of the ways that you can do that is you can sell or you can write straddles and covered calls on long position stocks that you actually own, and just kind of collect the premium. Again, typically this will work better in an environment where you're getting some levels of higher realized volatility, but the short vol aspect typically works much better in low realized volatility environments. So the contracts that you want to buy, because this is an options strategy that attempts to replicate futures contracts, and part of the reason that you're attempting to replicate the futures contracts is that you can do them cheaper in the option, and there's some asymmetric risk associated with an options with an options synthetic future strategy versus actually going out into the futures market and posting margin, where you can be exposed to considerable loss of the position, or the market were to go against you. So in this strategy, you're typically going to buy options that expire between 90 and 180 days. However, there are some elements to the strategy where you want to pair those with shorter dated options that will expire in either 30 days or a little bit less than that, and sometimes you can actually add a little bit more directional gamma exposure via significantly shorter dated options that are only 2 weeks till expiration. The 90 to 180 day contracts will give the portfolio significant exposure to Vega. It's just intrinsically more Vega exposure. And again, directionally, adding the short dated options is an attempt to sort of kind of juice the returns and add a bit more of convexity and give you a significantly higher exposure to gamma. But if you go overboard and add too many, it can completely work against you and drastically completely mess up the actual strategy. The burst that you'll get from adding that directional gamma on those shorter dated options is really explosive when you're positioned correctly. So the strategy produces results similar to a CTA Trend Following due to the asymmetric and convex profile of the portfolio, and in general just the returns. So if you execute the strategy correctly, it kind of can give you actually the holy grail of portfolio returns, in the sense that you get returns that are, one, positively skewed, relatively medium kurtosis. You get excess alpha compared to the market portfolio, and you also have substantially uncorrelated risk with the market. So it's it's cheaper than posting margin to acquire similar future exposure if implied and realized volatility remains substantially low. Again, that's the asymmetric payouts of using the option strategy in an attempt to replicate futures exposure. on, in this case, the Dow Jones Industrial Average. So you use DIA as a way to gain that exposure and to create that sort of convex portfolio and get those returns that are going to be positively skewed. And like I said, the real crux of doing this correctly is making sure that you know, one standard deviation to the left side, you'll be in the market buying versus the mean. And then on a one standard deviation move to the right side, you'll be in the market selling and taking profit. And hopefully in both cases, you're able to extract some sort of carry on what you paid for in terms of implied versus what you're receiving in terms of realized. So it is a long volatility strategy in which you're anticipating that the volatility that you pay for when you initially go into the one standard deviation, mean reverting, is going to revert, and it's ultimately going to be higher at the end of it, so that you extract the difference between the implied volatility that you paid for and then also the realized volatility, so that you have a spread between those two. If you don't have a spread between the end of it, obviously the strategy doesn't work, and you ultimately lose money in each of those cases. But you have to have the patience to stick with it, because again, it is mean reverting on the fact that returns in general tend to be mean reverting. And ultimately what that means is that you know, if the market moves 0.37% in any given week, you want to buy the market if it were to move down 1.5%, and you want to sell the market if it were to move up 2%. So those are pretty much the one standard deviations from the mean on the market. Obviously that's changed over the course of this year because volatility has been heightened, so you're getting much more wider swings, so you have to move those the strategy out further to increase the width. But if it's executed correctly, and it's a systematic strategy that probably would do better being programmed into a computer where you're just allowing the computer to do it, versus having a human being actually trading it and then taking emotional and psychological ideas into incorporating the strategy. So anyway, this is just a video that sort of kind of explains a mean reversion synthetic futures strategy that ultimately, if done correctly, can be pretty profitable. And again, long volatility, so it benefits in general from rising realized volatility. So any situation where realized volatility starts to increase and is higher than implied, you're actually going to benefit from this, which is typically not standard and rare, right? Typically you have implied that's significantly lower than realized up until recently. But in general, it's probably a good strategy if it's executed correctly and taken off. Okay, so hopefully you like this video. I'll probably go back to some of the economic videos, but just want to throw this one out there. So thanks for listening.